Chapter 14. Investing active or passive. To invest, you can take two different approaches. Either you buy individual assets after examining all available facts and in-depth analysis of risk and benefits. Once you have decided that a particular asset is the best possible purchase for your portfolio, you press the button. This method is active investing. Alternatively, you can buy a basket of assets based on macroeconomic factors and hope that most of the assets will do fine in the long run. This approach is called passive investing. In the context of capital markets, when you buy an individual bond or stock based on relevant facts available for its issuer, you are an active investor. Conversely, when you purchase an index fund or group of assets, you are a passive investor. It is important to note that buying a mutual fund or ETF does not automatically make you a passive investor. There are many mutual funds and ETFs, which are actively managed like a hedge fund. Some of these funds are based on highly active strategies. If your mutual fund is actively managed, you are an active investor. Similarly, buying an extensive portfolio or keeping stocks for an extended period does not make investors passive. Peter Lynch had an extensive portfolio, and Warren Buffett kept stocks for a very long time. Both are active investors because they choose their portfolios one asset at a time, not as a basket of assets. These days, many traders use ETFs like SPY or QQQ as their primary instruments for their day trading or swing trading. Using an index fund for trading does not make them an investor, let alone a passive investor. To qualify as a passive investor, you need to buy an indexed mutual fund, or ETF, and intend to hold it for a long time. You don't buy or sell based on day-to-day price changes. You don't react to market noise, political news, and daily news feeds. You know that over time, a basket of good quality assets will provide handsome returns. Active investing. Investing is not a zero-sum game. Trading is a zero-sum, or, more accurately, a negative-sum game. Investing is not trading, and it is not a zero-sum game. It is a positive-sum economic endeavor. An economic generating asset is expected to generate income and is expected to increase its value over time, regardless of the accuracy of buying price or market efficiency. Let me elaborate on my point. Earning assets generates income over time, and this income is added to the intrinsic value of the asset. For example, if you buy a $100 stock that always trades at 100% of its book value and generates 10% income per year, everything being equal, next year, this stock should trade at $110. This added income makes investing a positive-sum activity. Inefficiency of market. An active investor believes that capital markets are inefficient and moody. Sometimes the market is depressed and gloomy, and sometimes it is joyful and carefree. This bipolar characteristic of the capital markets creates opportunities for a smart investor. Active investors try to take advantage of these opportunities. Beating the crowd. An active investor understands that market prices represent all available facts plus the sum of emotions of all market participants. It is the crowd behavior that makes the market exciting and inefficient. However, most active investors fail to realize that they are part of the crowd themselves. They are trying to beat the crowd while being the crowd. Not every or even majority of active investors can beat the market. Most active investors make money, but few beat the market. If active managers win, it has to be at the expense of other active managers. And when you add them all up, the returns of active managers have to be literally zero, before costs. Then after costs, it's a big negative sign. Eugene Fama. It is all random. In the late 19th century, Sir Francis Galton demonstrated a device named Bean Machine, or more famously known as the Galton board. He proved that all large samples fall into a normal statistical distribution purely based on random factors. In the context of investing, when millions of investors participate in the market, there will be few who are exceptionally successful just because of random factors. When things go our way, we reject the lack of certainty. Nassim Taleb. For example, if an investor decides to invest $1,000 each month from 1996 to 2000, on the newest IPOs without considering a damn thing about the business or company. This is an investment of about $60,000 over 5 years. In May 1997, he invested the same $1,000 into Amazon stock that translated to over $1 million in 2020. Suppose all of the other 59 investments went to zero. Was he smarter in May 1997 and a fool for the rest of the 59 months? Not really. It was pure luck and randomness. When millions and millions of people participate in a market, most of them perform 1 or 2 standard deviations away from the market averages. However, some do really bad and some do really good. Warren Buffett, Peter Lynch, and many others are exceptionally successful investors. However, a lot of things went their way just by pure luck. Sure, they are remarkably talented, but being extremely talented is a random event on its own. They were born in countries with highly developed capital markets. Circumstances beyond their control made it possible for them to participate in capital markets. Not every talented person turned into a new Warren Buffett. History is not on the side of the active investors. The whole purpose of active investing is to beat the market. However, historical data is not in favor of the average active investor. It is mathematically impossible that most people perform better than average. Averages are calculated from the performance of all participants. It is not a milestone that most investors can cross. If you are an active investor, you should realize the fact that it is statistically more probable that your performance will be 1 standard deviation away from market performance, if you are lucky. Historically, only 1 out of 10 active investors make any money after fees and commissions, and only 1 out of these 10 beat the market. You have only a 1% chance of beating the market in any particular year. Beating the market consistently year after year is a dream that very few people could have achieved. It is not impossible, but highly improbable. If the data do not prove that indexing wins, well, the data are wrong. John Bogle. Passive investing. Unless you've just spent the last decade looking for Elvis, you know that indexing most asset classes will beat most active managers. From time to time, a majority of active managers in a given asset class will beat indexing, but this usually doesn't last very long. William Bernstein. The textbook definition of passive investing is to buy a large basket of assets without the intention of selling or swapping and keeping the basket for a very long time. Late John Bogle, the founder of Vanguard Group, is the loudest advocate of passive investing. John, throughout his professional life, actively promoted passive investing. There are several benefits of investing passively. It is easy, guaranteed market returns, and it is almost certain to beat everybody in your circle over a long period. The best way to own common stocks is through an index fund. Warren Buffett. The most extreme form of passive investing would be buying an index fund with every public company stock and every publicly traded bond. I don't know anybody who does passive investing to this extreme. Nobody does. It means all of us are active investors to some extent. The most extreme form of active trading is high-frequency trading, and most of us are somewhere between the two extremes. Some are closer to HFTs and do day trading, and some are closer to total world index funds and keep most of their investments in broad market funds. When people say market return, they usually mean S&P 500 returns. Step back a little and look at S&P 500. It is a highly concentrated exposure in US large cap equities. It is not textbook passive. If your 100% exposure is in S&P 500, you are highly concentrated in large cap US equities. If this group does well, you will do well. You are missing the rest of the world plus all the bonds. There is nothing wrong with investing in S&P 500, but it is an active decision, and as an investor, you must understand and appreciate the risks and rewards of your decision. Extreme forms of passive investing. As an extreme passive investor, you may choose to invest in a total world mutual fund, but you will not make any money other than a little more than the inflation rate. When you invest in the entire world, you must understand that you are buying a proportionate share of the world's total wealth. This total world's wealth is measured in dollar value, or whatever the currency, but eventually translated into dollars or your currency of accounting. This total wealth or total money supply can only be increased by the generation of money by sovereign governments of the world. It means that the total world mutual fund can only grow by the money generated by the governments. An increase in gross domestic product or GDP does not increase the money supply, so GDP change does not impact the total world mutual fund performance. Let me explain my point. For example, I am a farmer, and this year I worked really hard and doubled my potato production. Assume the rest of the world stayed at the same production level as last year. Nothing changed except double production of my potatoes. GDP of the world has increased by the weight of this excess production, but as the money supply is exactly like last year, the total amount spent on potato purchase will remain the same. It means either these potatoes will go to waste, or the price needs to come down to accommodate the purchase of excess production. Overall, the world economy will remain the same in dollar terms. Thus, there will be no change in the total world mutual fund's value. To give an illusion of GDP growth, governments increase the supply of money and keep a specific percentage target of annual inflation. For example, in the US, 2% to 2.5% is the target inflation rate. A total world mutual fund can only grow by the increase in money supply, thus little over the rate of inflation. Some of the increase in money supply is cushioned by consumption growth due to the growing population. The rest is reflected in inflation. Investing into a theoretical total world mutual fund is impossible, as not all businesses are listed or incorporated. A majority of trading activity, including trading goods for goods or goods for money, is outside of investable listed securities. Any available global mutual fund suffers this primary shortcoming, and it is a good thing. All listed companies, by definition, are more successful than non-listed or non-incorporated businesses. Because of this inherent limitation or advantage, a global mutual fund does a little better than inflation. Between the two extremes of active and passive investing, there is a sweet spot where returns are high and almost guaranteed over the long term. This optimal mix of active decisions with a passive approach is more towards the passive side rather than the middle. However, after this sweet spot, returns start going down if you move much closer to extreme passive approaches. The optimal mix of active and passive approaches is unique for every investor. You need to find your sweet spot yourself. Nobody can do it for you. My combination is unique for me and will work only for me, and your mix is exclusively for you and will only work for you. The good news is that this theoretical optimal mix is only a point of maximum possible return. Anything close to that point will still give you very satisfactory returns. Why people do active investing. Every serious investor, active or passive, knows that passive investing gives you better returns. So why do a large number of investors still choose to do a highly active type of investing? Survivorship bias of active investors. Although many active investors make losses or perform worse than the market average, we only hear about exceptionally successful investors. Nobody talks about people who tried trading or active investing and left it with huge losses after a year or two. These people are only a part of the statistics, but great investors have larger-than-life statues. If you talk to any active investor, he will throw Buffett's name in no time. If Buffett can do it, anybody can do it. Nobody says that if millions lost their hard-earned money trying trading, perhaps I will fail too. Everybody thinks that he or she can do better than average. Passive investing is boring. Activities around picking your stocks are fun and thrilling. It feels like a game. It feels like we are doing something to earn the profit. And if we are losing, there is something that needs to be corrected in our actions. On the other hand, passive investing is boring. Nothing to do. Nothing to correct. Even when we make money, it feels like nothing. Active investing looks easy and intuitively appealing. If you pick any market average, S&P 500, Russell 2000, NASDAQ Composite, there will be almost half to one-third of the stocks in all averages, which are clear winners. Who doesn't know FANG? Nvidia is easy. How about Costco and Walmart? Easy, isn't it? Picking stocks is intuitively appealing. It looks easy. Just pick market winners and you will do better than the market average for sure. However, in reality, it is not that easy. If it is that easy, why do the majority of professional investors lag? They lag because the majority are supposed to perform worse than the market average. As John Bogle said, it is the law of humble arithmetic. Let me try to explain this. Suppose every investor follows this simple strategy of picking only winners and avoiding losers. What will happen? The winner's stock will go to the sky. On the other hand, losers' prices will go to zero because there is no buyer of these stocks, only sellers. While half of the prices are going to the sky, the value per dollar spent must be going down. Conversely, in the other half of the companies where prices are going to zero, value per dollar spent must be going up. At some point, these two values per dollar spent must cross each other and keep going in opposite directions. Some people will realize the inverse gap in value and will start making contrarian bets. These are the legendary investors we hear and talk about all the time. These are the ones who keep their focus on value, not the price. And they are the ones who make oversized gains. Believe me, these investors are few and far between and are a very rare breed. Active investing feels like being in control. Active investors feel that they are in total control. Any investment can be sold or replaced by a better one at any point. If something is not working, just replace it with something that is working. On the other hand, passive investing feels like helplessly floating on the ocean surface like a dead piece of wood. It is up to the mood of the water whether this helpless piece of wood makes it to the shore or keeps floating for an unlimited time. Why not grow a limb and make some effort to reach the land? Do something to perform better than this lousy average. However, most of these pieces of wood make it to the land, and most of the people who try to fight the waves go to the bottom. Only a few, strong and determined, make it to the shore. Endowment effect. People believe, with all honesty, that the stocks that they picked will do better than the market average. They think that the act of buying a piece of asset somehow increases the value of that asset. This cognitive bias is called the endowment effect. That's why people keep holding their stocks even though it has become clear that selling is better sooner than later. So why does the endowment effect force people to do active investing? It all starts with research that is needed to pick a stock. Potential investors suffer from the endowment effect because they own the thought process. Somehow, everybody thinks that the research they did is better than the research of the person who will be the ultimate seller. But that's how the world works. If I honestly think that my opinion is as good as the person I am buying from, why would I buy? Of course, I believe that my opinion is better. The belief of having a superior thought process leads to the actual transactions, both for the buyer and the seller. To be a passive investor, you need to give up this belief that you have a superior, or more correctly, an above-average research methodology. Once you realize that you can beat the average investors by a wide margin, by not trying to beat the averages, you become a passive investor. Chapter takeaways. Buying a mutual fund does not make you a passive investor. If your mutual fund is actively managed, then you are an active investor. If you are incredibly talented and extremely lucky, you will beat the market most of the time. Everybody else will be better off investing in low-cost broad market index funds. Total world index funds can only grow a little better than the inflation rate because the world is a closed system. All investors, including most devoted passive investors, take some sort of active decisions. All of us are somewhere in between high-frequency trading and the total world index mutual fund. The more investors do active trading, the more it makes sense to do passive investing. However, it is possible that in the future, if enough people engage in passive investing, then it can be beneficial to do active trading.